Probando, uno, dos.
Me dicen el verso limpio y sin arrugas, vengo terso, adverso a esos que me quieren ver converso. Dicen que las letras de mis temas son muy fuertes para una masa que no escucha, solo baila, solo mueve. Quieren que siga aquel modelo, mucha promoción pero un sonido bien craquero. Pa' meterle el pie a la gasolina todos son buenos, pero pocos saben darle al freno, que no, bueno. Y es que hoy todos quieren ser primero, pero en cada examen que doy se van con cero. Se alaban tanto que hay que ponerle un babero, pa' que no manchen de babel ego. Y ya se paró este varón con el sonido campeón, aplastando a los que escriben temas de cartón. No te asustes si te encuentras este tren de frente, no te pique, y si te pica es que tienes que meterle más. Observa bien en dónde estás, eres privilegiado por nacer en esta faz de la tierra, que tiene demasiada historia para ser representado por la escoria. La memoria colectiva sangra por la herida, pero sigue viva y seguirá viva donde haya oídos, donde haya corazón. Documentada en el sonido campeón, que nacer con el don es una bendición. No un pasatiempo, pa' mí no es distracción. Prestarle atención a la tradición, la música boricua una expresión. Y ya se paró este varón con el sonido campeón, aplastando a los que escriben temas de cartón. No te asustes si te encuentras este tren de frente, no te pique, y si te pica es que tienes que meterle más. Tienes que meterle más. Tú eres la cultura, negro, date a respetar. Si quieres representar, ponte pa' tu número, tú de seguro tienes más. Claro que tienes que meterle más. No eres lo que tienes, solo eres lo que das. Deja la mediocridad. Si puedes, tírame con algo original. Vengo terso, adverso a esos que me quieren ver converso. Si saben que no me dejo llevar por eso, yo sigo bien paciente en el proceso. Mientras la musicalidad va en retroceso, la originalidad sigue perdiendo peso. Tienen a todos enfuscados con la fachada, no importa si la letra nunca dijo nada. Yo se la doy por la presentación, mucho trabajo metiendo presión más. Si quieren representar a nuestra isla, tienen que apoyar mejor la pista. Y ya se paró este varón con el sonido campeón, aplastando a los que escriben temas de cartón. No te asustes si te encuentras este tren de frente, no te pique, y si te pica es que tienes que meterle más. Tienes que meterle más. Tú eres la cultura, negro, date a respetar. Si quieres representar, ponte pa' tu número, tú de seguro tienes más. Claro que tienes que meterle más. No eres lo que tienes, solo eres lo que das. Deja la mediocridad. Si puedes, tírame con algo original. Vamos a ver que los mochos son para la maleza. Aquí no nos vengan con mochos. Que la sheets. But lately you've been acting like you hardly know me. I've only recently began to fall. I feel the need to go and waste it all. I try to numb away the pain. I hope someone is watching me, watching me, baby, watching me. So baby, won't you say so? Baby, come home. So baby, won't you say so? Baby, come home. So baby, won't you say so? Baby, come home. So baby, won't you say
Yeah, yeah. The world is so small till it ain't. Yeah. I'm building up a wall till it break. She hated when I call and it's late. I don't wanna keep you waiting. I hope I never keep you waiting. Yeah. I think I know it all, but I don't. Why you always at the mall when you're broke? Yeah. And I just wanna ball, maybe dunk, but I never been tall. Yeah. I might trip, I never fall. God knows I came close.
Don't try this at home.
I know I probably need to do better. Fuck whoever, keep my shit together. You never told me being rich was so lonely. Nobody know me. Oh well, hard to complain.
Bienvenidos a la sesión del día de hoy, 15 de diciembre de 2024. El día de hoy es para mi compañero y amigo Brian, entonces es en inglés. Hello Brian, welcome. Welcome this December 15, 2024 to the top-down analysis and why traders lose their money session. I see that there's one person watching. I'm guessing it's you, Brian. I want to go over the silver futures market. Last time that we were live, even though it was in Spanish, we were talking about the possibility of silver coming down to fill this 1 hour imbalance. And the thought process was, we thought we were in a distribution here. I was wrong. Nonetheless, there was some reaction to the downside. But then what ended up happening is an even bigger distribution. So this is why I wanted to talk about top-down analysis, to learn about, if what mistakes I made by not considering higher time frames for this particular trade. Which I actually didn't take. I actually said in the live session that I said silver is looking like it wants to retrace to then go higher. That's what I said, and it's recorded. But ultimately, price ended up taking December 9 high, which was, I thought that it was gonna be taken after the imbalance being filled. So this is when it ended up happening. We ended up doing two highs above that December 9 high, and then ultimately we melted down to this imbalance. So, even though the price action wasn't exactly what I was expecting, ultimately we were expecting the silver to come to this imbalance. Now, what happened next in the present is this price action. I wanted to go real quick and tell you what I find out and how I find out about this. And I want to, make the top-down analysis since the beginning with you right here. I know you are reading Trading in the Zone. I know that you started with that. Congratulations. Um, if you want to talk about any of that, uh, be my guest. Type your comment, type your question, and we'll discuss it. Actually, there is this second section, why most traders lose their money, and I think it's going to be a very good moment for that conversation. But for now, I want to go over the top-down analysis on silver. Um, and yeah, I mean, I figured that I didn't consider all this liquidity. I thought that the market was going to make a low and then higher. But ultimately, we do have liquidity here. We have equal lows here in 1 hour, and a imbalance created on manipulation. Imbalance created on the way to manipulation. So there's two things that I want to talk about in top-down analysis. I know that we've been in contact for years now, and you have some notion of some concepts, but still, um, while I'll go to the top-down analysis, I will mention the concepts. Let me know if you have any questions. Um, and also, I encourage you to start marking up charts. Okay, so um, this is what ended up happening. Silver market came down, pick up liquidity, came down to this inverse imbalance, and well, it's the seasonality of bullish silver market. So other than retracements, we should be looking for buys. Okay, so I'm going to delete everything. I'm going to go to the spot market. That way we have more data feed, and I'm gonna start off in monthly. I'm going to delete everything. Okay, and I'm just gonna watch um, price from a point where I think it's not coming back. I think um, silver is not coming back for $4 per ounce. So this is the start of the range, and this is the end of the range, which is $48 per ounce. Um, so now we have a range, and there's, a narrative, and there is price action that got us from here to here. And top-down analysis is going through bigger to smaller time frames to then be aligned, um, and don't get lost, right? Like my mentor says, don't get lost in the sauce. So we have this low, we have this high, and in the way up, we see, for example, right here, market, um, trapped all these buyers. So we have buyers here, we have buyers here, we have buyers here, we have buyers here, we have buyers here. So they put their stop loss here, and on their way up, they trail their stops, and so liquidity starts to build in under this low, under this low, under this low. So, we have established that smart money takes out, but smart money fills their orders by taking out weak hands. So whoever, sold their position here, now smart money is buying. So this right here, it's an institutional candle. And then we see price react up from $8 per ounce to $50 per ounce. We know the market was manipulated, but by some brothers with great capital and power. I don't remember the dates, but we see expansion, okay, after manipulation. What is the manipulation? Manipulation is under this low. And then we see retracement, expansion, and this is the last candle. We see the market come back to it and then react. Then from 2014 all the way to 2020, so 6 years of building orders in the downside and building orders in the upside. So we have liquidity building in the upside and liquidity building in the downside. We know smart money is in drawdown here. We know they have open positions here that are in negative, so they need to come down, but they won't just come down. They will accumulate positions and then finally fill their order by closing the selling power here to then add more buying power. So that's the price action we see in the monthly, and then we continue with this thought process. What was what's going on? We have this mitigation zone right here. So I'm finding the narrative and I'm finding the story on, until I get to the present. And then that way I have, into consideration higher time frames that I might not be aware of if I start right in 1 hour and right in 15 minutes. So in this sense, I know that um, on October 1st, which was not too long ago, on October 1st, we took November 1st, 2002 high. That's something important, and that's something that we wouldn't know if we weren't looking at a monthly time frame. So that's important. There's liquidity built in that high. Okay. So mitigation, kind of like the same thought process. They're in open negative equity here. Okay. So they bought with the I'm sorry, they bought with the intention of selling, but while they were um buying here, they were selling at the same time, so they're in negative equity. They need to come back, close the negative equity, and continue buying. So again, we see market before doing the move, building liquidity. Remember, we're in a monthly. Five, 7, 6, 5. Give me a minute. What's up, Tony? I saw your message. It's just that I already welcomed you. If you have any question, man, let me know. I'm here. Okay, so in this gray rectangles, I'm just marking up um, market, sideways market. So it's not an uptrend, it's not a downtrend, it's just sideways. Sideways. So in this market is where liquidity builds, right? We have sell power, we have buying power. So liquidity builds under and up and under. So we go from liquidity to liquidity, which means we capture liquidity and then we go directly to opposing liquidity. Build some more liquidity and capture it while at the same time closing the negative positions. Okay, so we continue to the present and we have November and October. October took 2002 November 1st high, and then we have sideways market. So I think there's a great chance that the silver market will retrace. I might be wrong, you know. We're still in the monthly. There's an imbalance here. There's an imbalance here. It's too soon to have a bias. I'm just marking what's going on. We came down to institutional candle. We had the expansion. We came down to mitigate, which is kind of the same thought process. Did an institutional candle in the process react, and then came down again, same thought process to close negative positions in this. Remember, we're thinking how smart money thinks. Who is smart money? Institutional money. Who controls price. So I'm curious to know if we're about to retrace. Um, Silver is in a very bullish season. Um, so you know, I don't know. Let's go to weekly. In a weekly, right as the bat, I can identify um, this as low resistance lows, which means retail traders, buying. I can identify as well that inside that monthly imbalance, we have a weekly imbalance inside. What else I can notice? Well, there's an imbalance here in the weekly that was filled and then reacted. So we have efficient price and then not efficient price. We have not efficient price and then came back to be efficient price, but left low resistance lows in the process. And we have an imbalance here. What else? What else I can notice? That's in a weekly. Now let's go a little more in the present. I'm still in the weekly. There's an imbalance here that we reacted off of. I cannot, ignore the fact that there was liquidity built there that was captured. There's an institutional candle here Then we have the reaction, came back to it, and then had a reaction again, and took uh, November 1st of 2012 high. I'm sorry, 2012. So we're talking about a high of more than 12 years. That's top-down analysis, considering that type of things, you know. Another thing that I can um, identify is that market created an imbalance on the way to manipulation. This is what we call manipulation when we grab a previous high, either a previous session high, previous day high, or in this case a previous decade high. So I think this is of impact. We have an imbalance on the way to manipulation. We trade through that imbalance. So what was once bullish, now it's bearish. We came back to it and reacted off of it. So, this is a weekly. We have an imbalance here. So we're in the middle right now. And then we also have, buying orders accumulating here. This looks like low resistance highs, but this is a strong candle as well. So let's go down to the daily. And we can appreciate that, inside this weekly imbalance, there's a bigger daily imbalance that if I cut in half, it kind of like it's in the low end of the weekly one. I'm gonna take that off and I'm gonna mark this daily institutional candle that is under this um, weekly imbalance. So I think there's a great chance that the silver market will come back to this institutional candle, feel this daily imbalance in 100% because it has came 1, 2, and 3 times. So I think the market really wants to fill it. Something like this. Now, I haven't established, if I'm going to buy or if I'm going to look to sell in the next, days. All I know is that the silver market is super bullish. I have an institutional candle in the downside, and I have a daily imbalance that I have, respected 2 times, and I have captured September 18 all the way to November 14 liquidity on November 28 and had a reaction to the upside. But, like my mentor says, this doesn't look like a capture liquidity. It looks like, it's just building more buy orders. So I don't know if I would, sell because it's a bullish market, but I do see the possibility of the market retracing lower before going higher. There's a mitigation here because we have a high, a low, a higher high, and then a lower low. So that's why this right here, it's a mitigation model. So now I would expect for the silver market to do this Okay, I don't know how or when, but I really like this price action. Okay, I don't have a crystal ball. I don't know what's gonna happen. I'm gonna go to 1 hour. In 1 hour, what I failed to see when I was looking for the market just to come here and respect this low is I failed to see that we have liquidity here and liquidity here. What is liquidity? Liquidity is either a set of equal lows or low resistance low. A set of equal highs or low resistance highs. This is liquidity in the downside. This is liquidity in the downside. This is liquidity in the upside. This is liquidity in the upside. So you see low, slightly higher low. That's this. It's low resistance low. You see equal lows. That's this. Equal lows. So this is liquidity. These are targets or entries below the low. So I failed to see this, and that's why I thought this low was gonna hold. Obviously, I was wrong, and I don't have any problems admitting that, you know. Um, I'm sorry. I was talking about this low resistance lows and this equal lows. Sorry, I was covering it. All right. I thought we were going to respect this low because it's a fractal low, and because I failed to see again this low resistance low and this equal lows. I was expecting lower prices and then higher prices. We got lower and then lower. So now I'm looking at this high resistance low high. So this is one of the reasons why I might consider a short. A very quick one is because we have high resistance highs. So this is low resistance because it's slightly lower. Low resistance high. I'm sorry, it's equal highs and low resistance highs. This is low resistance highs and this is equal highs. This is not neither one. This is high and then higher high and then melt. So this is a high resistance high, and now I would expect market to come back and go lower. But again, we're in a bullish market, but we have a high resistance high here. So I wouldn't expect the market to go and go and go and go. Let's go back to the daily. Yeah, no, I don't think it's finished. So I'm thinking maybe we get this, you know, by tomorrow morning or next session. I don't know, but any questions, Tony? They had low resistance highs here, low resistance highs here, and then we have well, this price action that took this and this liquidity. And then if I justify it, what was price reaching for? We have manipulation that takes liquidity, a balance created on the way to manipulation, here again we have liquidity building, and then we have manipulation, an imbalance created on the way to manipulation. We extend that imbalance, come back to it, react off of it. Same thought process. Very intense stuff. Still following you, no questions. Okay. We create again a set of low resistance lows here. Okay. So we come grab this liquidity while we go down there. So we leave another imbalance on the way to manipulation. And then we react off of it, equal lows, which is this, and then expansion, and then low resistance lows, which is this, and then we see price do what it does. Now we see this price action right here that took this, and came back to this inverted imbalance, like to the T, perfectly, exactly. So now, with considering price action from 2012, and being that I'm in a 1 hour time frame now I can go to a 15-minute, and with all the security, uh, of where I'm at in price and what I'm looking at. Right off the bat, I have low resistance lows, which is again here. This kind of looked like low resistance, not equal lows. This is equal lows when it's equal, and this is low resistance, but it's too tight. There you go. So liquidity, 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 liquidity building under, liquidity building under, liquidity building up, liquidity building up. So this creates here. This is what retail traders are looking at. This is what retail traders are trading. So they put their stop orders above it, and you have this liquidity building up. At the same time, you have, I'm going to make this invisible for the minute. We already established this is manipulation. So what I can identify in a 15-minute, it's both in upside and downside. We have low resistance lows, and we have equal highs. So there's liquidity here and there's liquidity here. So if I take an order right now, I'm in low probability conditions because I have liquidity in the upside and I have liquidity in the downside. So anything can happen, that can happen or this can happen. So being in the middle of a range of internal and external liquidity, it's very dangerous to, you know, um, trade if you don't know where you at. Another thing that I can consider is that I have a imbalance right here. Okay, I have low resistance highs here, which in a very short term, it's a high resistance. Because it's slightly higher. But nonetheless, we still have all this. Okay. And I do believe price might come down to the 50% of the mitigation model or something like that. So I wouldn't touch this right now, but definitely I would be expecting higher prices. If I go down to a 15 minutes, I know I would be buying under this lows, but if I go to a 5 minute, another thing that I failed to look at, it's this, Brian. So in the future market, which is what I trade, I was looking at this. I thought price was gonna go down, okay? And you see how we have in the futures feed side of the market, we have high resistance highs. So that's why I said, okay, this is going lower. But then you go to the spot market and what was low resistance highs there, here is equal highs. So I failed to look at that. In the future market, we're in the future, silver futures. This is a high resistance high, and that's why I thought we were going lower. But in the spot market side, that same time was equal highs. If I would have considered this, I wouldn't thought the market was going lower. I would have, have this as a target, as a matter of fact. It looks perfect. It looks too clean. So this is what I learned, downside liquidity, and then went directly to upside liquidity. And on the process, we came back to fill this imbalance. In 100%, almost. So we just came back to it, came back to 50%, almost, came back to the upside of it, and then came down almost to the bottom side of it, and then reacted. So if I would have considered the spot market, I would have, tried and buy here, and I would have closed my buy position above this highs. But it is what it is, it is what it is. I did not trade it, so I don't care. But ultimately, the market did what the market do. If I go 5 minute in the silver futures, there's a mitigation here that has not been touched. If I go to a 5 minute in the spot market, the same price action, it did already touch the mitigation. So top-down analysis is not just considering, higher time frames, it's also considering other feed on different markets of the same thing you're looking at. For example, if you're looking at, the NASDAQ, it doesn't hurt to look at the major technology companies once in a while how they're doing, because if the NASDAQ is a tech industry, then, once in a while having into consideration if the majors of that index, how they're doing, if they're doing well, if they're strong or if they're weak. In the same sense, if you're gonna trade silver futures, consider silver spot market and consider also big silver mining companies, which is why I have them here as well. Okay, so I think market has the great possibility of coming down to this um, inverted imbalance. I don't know if today or when, but I do think market has a great chance to come here and then trade up. So, I'm not telling you to long. I'm not telling you to take a trade. I'm not telling you to risk money. I'm saying this is what I might take one of these days. It might be this London session. It might be tomorrow. I don't know. I'm not gonna rush it, but I like that price action. Okay, and I wouldn't have the security uh, of doing so if I wouldn't be considering higher time frames. So that's top-down analysis. Do you have any question? I would like for us to concentrate the next 10 minutes into psychology and you know understanding of the nature of the markets. I know you started your trading in the zone book. Tell me, Brian, tell me a little bit about it. What is it that you have thought about? What thought process is? Tell me a little bit about uh, what have you learned reading the book? Yeah, discipline. Awesome. So discipline, it's something that uh you've been resonating with, huh? Tell me a little bit of why that word in particular has caught your attention, or in general reading the book. What is it about the discipline? Tell me about it. You can be open about it. That's the whole thing. I share my mistakes here as well, and that's the whole point. If someone else is looking at it, and and I read your answer, and or read your question, maybe they're going through something similar, and maybe they can learn about it too. So if you don't mind me like elaborating a little bit more with what you mean with discipline. Maybe I've been struggling with something, or I don't know, related to trading, or the markets. I'm gonna serve myself a little bit more tea. I'm gonna give it a minute for you to type to me, uh, your points or your take on what you've been reading and what you mean with the discipline part. I'll be right back. I'll be back in 2 minutes, and I'll read to you. I'm back. So it's a good book. I'm learning discipline more so. The opportunities are always there in the market. Yes, greed and risk management have been my biggest concerns. So the discipline of being able to handle the opportunities, and so to manage the risk and the trade because of the emotions. And I understand. I mean, I went through a losing cycle for a lot of years, and it's because I had the wrong expectations. And that's why I want to talk with you about why most traders lose their money. And I got all this from John Fibonacci Advanced Technical Analysis. It's a book he put, um, a guide to high probability trading by aligning with smart money. And he does talk about, and references and mentions also Mark Douglas. Um, Number one reason why traders lose money in the markets is because they come to this environment with the wrong expectations. They think they're gonna become rich fast. They think that they're gonna make $500 because they're late on a payment, or because there's an emergency and they need money. That's a wrong expectation. Mark Douglas, he interviewed all kinds of traders, all sizes, and he put together a book where he describes you the psychology. It doesn't matter if you trade $1,000, $100,000, or $1 million. It doesn't matter. If you have the expectations in its wrong place, you will lose. Because when you have the wrong expectation, that automatically puts you in a position to commit all the other mistakes. You see? So you have to have the right expectations. You have to understand that uh, this is a career, it's not a hobby. Hobby costs money. Careers also cost money, but careers are to, being able to uh, make a living out of this. I cannot make any guarantees Nonetheless, all I can do is consistently talking about what it took for me to make it happen for me. So having the right expectations, okay? It might take a year, it might take 2 years, it might take 3 years because it's a career. It took me 8 years. So don't expect to come here and just, you know, dominate in the first year. There's nothing wrong with taking your time. Focus more on the process of learning. Don't focus on making money. At least right now, don't think about making money. Think about understanding the expectation. Think about understanding the nature of the markets. Okay. Another reason why people lose their money is because they don't have a plan. They take a trade, and once they are inside the trade, they don't know what to do because they don't have a plan before they take a trade. So you need to know before you enter what are your risk parameters, what are your profit objectives, and what are some of the limits that you would put yourself in a 24-hour basis, in a weekly basis, or a monthly basis. Like, for example, I'm not gonna permit myself lose more than $500 in one day, or lose more than 1% in one day. That's a trading plan. If you don't have a trading plan and you're trading, you will automatically fall into more mistakes again, because you gotta know exactly what your expectations are. So if your goal is to make $2,000 a month, you know, and you made $2,000 with one trade, or let's say you did $2,000 with two trades in one week. So now you can log out and not trade in the next 3 weeks because you have fulfilled your goal. And now you have time to go enjoy. But you see the greed, it's interesting that you mentioned greed because let's say you have a goal of making $2,000 a month and you make $2,000 in one week. The greed will invite you to continue risking your money when you already did your goal in the first place. So not only are you risking the money you already made, you're risking your capital, your mental capital, your emotions, because now you're gonna get more frustrated and you're gonna get more mad at yourself if you go ahead and lose what was already yours. So having a trading plan before taking trades. Trading without risk management is another reason why people lose money in the markets. They don't understand that, you know, if you're buying stocks spot, or you are trading futures with leverage, it doesn't matter. It involves risk and a lot of it. And people don't really understand the risk that implies. So sometimes we're just, excited to participate and we're excited to, execute an order, but we don't have risk management in place. We go ahead and lose 1% in a night, and we want to revenge trading. We want to trade again because now we want to make that money. We want to make that money back. So now you're not trading because of probabilities. Now you're trading emotionally and without a risk management in place. Another thing, another reason why most people lose their money in the markets is because they're depending their success on someone else. And this is detrimental. This is like very important. This is one of the most important parts that needs to be, addressed in today's date because it's very popular. It's very popular being part of a chat group. I was gonna make a group chat, but I regretted it because I'm not gonna promote what I'm saying that doesn't work. If you depend for someone else for your success, you are planning to be, you're planning to fail because If you're part of a group chat, and you're taking positions but don't understand the risk management, the trading psychology, and the trading plan and the strategy behind it, you're just fooling yourself because you don't have nothing to go back to and study and become better. And not only that, you're setting yourself for the wrong expectations. Okay? You have to determine your risk appetite, you have to determine your hours, you have to determine your instruments, you have to determine yourself out. Because in the markets, it's a place where you put the rules 100%. Okay? Not understanding that markets are different. Another reason why traders, most traders lose their money is because traders will treat the forex market the same they will treat the metals market. And for some people might sound obvious, but you would be surprised. 80-90% of traders, they don't even know the difference in margin requirements. They don't know the difference in capital requirements, or what's the leverage, or what's the the spread, or even what's the commission, you know, that involves and that implies to trading in different markets. You cannot think that opening one lot in Euro USD is the same as opening one lot in gold, And if you do think that and open a lot in or a micro lot in gold with $100 account, you're gonna get wrecked. Which takes me to um, this another reason why most traders lose their money is because they don't practice first on a paper money account, which is a demo. You want to learn how to open and close positions. You want to learn how to execute. You want to learn how to do all those things without risking real money on demo first. Okay? A lot of people want to jump right into real accounts, and this is why they lose their money because they commit the finger mistakes with live trading. When I'm telling you, you will commit mistakes. You will commit finger mistakes and lose money. So you might as well practice first in a demo account. Um, Not understanding markets are different. Quitting too early, you know, this is a career. It's a career. It takes time. And you have to understand that the price justifies uh, the I'm sorry, the reward justifies the price. What is the price? The price is practicing. The price is studying. The price is the price you pay is studying. It's hours. It's reading. It's avoiding pleasure. It's staying in when everyone else is having fun. That's the price you pay. The reward is that you will start to understand how to think in probabilities. You will start to know what you're looking at. You will start to know what you're talking about. So don't quit too early. Focus on the process. Do not focus on the results. Focus on understandment. Do not focus on the results. Focus on process, understanding, and knowledge. Okay? Don't focus on the results right now. But don't expect, for you to understand without putting the action. You have to come to the charts and start looking at the concepts and identifying these opportunities by yourself. Unrealistic expectations, it's kind of like the same we were talking about. you want to make $1,000 in one night because you need the money, this is not for you. Okay. And all of this, all of this will take you to trade based on emotions. Making the mistakes, not having a plan, not having risk management, relying on other people, not understanding that the markets are different, quitting too early, having your expectations in the wrong place, and living and trading with live money before demo account. All of this mistakes will make you to trade based on emotions. Even if you're a winner and you know what you're looking at and you understand and you take winning trades, this could be dangerous for you as well because the moment that you are trading from a place of false self-esteem, of thinking that you know everything, then that's trading based on emotions and you will lose um, every time you trade based on emotions because the market doesn't care about you. The market is the market, and the market will do what the market will do. So continue, you know, in this channel, share, like, subscribe if you find value, and I see you in the next live session.